Welcome to this Killik Explains finance video. This week, how stock market investors are wrong-footed by financial news, with some specific examples, just in case you don't believe me, and what you should do about it. Now, the background to this is, well, Adam Smith is said to have said, the stock market doesn't know you own it, all right? And that's important when it comes to you thinking about what might happen when important news is released in the economy versus what actually does happen next in the stock market. In short, stocks often don't react to news as investors expect. They can be disappointed as investors. You can think, that's crazy. How has that happened? That's true at an index and an individual stock level. I'm going to give you three examples of sort of like on macro data and its impact on markets, and then one example of company-specific information just to show you that this principle of unpredictability holds at all levels. And it's possible to be badly wrong in both directions. You can think, absolutely, this is positive data, stocks will rise and they can fall, sometimes quite sharply in the short term, all right, and the vice versa. And what's more, you can get reactions in the immediate short term and then further out. And calling them correctly is pretty difficult. Now, I'll give you just 3 or 4 examples to illustrate the point. So, non-farm payroll numbers. First Friday of the month, US data on basically company confidence, if you want to see it this way, economic confidence in hiring. If people are being hired, that means prospects should be good, corporate sector's expanding, so people watch this number like a hawk. When America sneezes, the rest of us catch a cold, so this number is watched, not just in the US, it's also watched here and elsewhere. Now, cover that, by the way, in more detail in another video. So keep it brief here. It's a key forward indicator, released on the first Friday of each month. It's a confidence indicator for many. May exceed or fail to meet expectations. Because it's such an important number, analysts spend their time trying to guess what the number will be before it's released. They have an expectation, so the number's going to beat it or meet it. Now, it's hard enough to try and guess what the number might be sometimes, even harder to predict the stock market effect. All right, positive or negative, short term, slightly further out. If the number is stronger than expected, just give you an example. So you might think, well, that means companies are hiring more than expected. That's positive, surely. The engine room of the global economy, the US, is firing on all cylinders. Good for the underlying economy, good for the stock market. Maybe not. Not as good as you expect, maybe not even good at all. Because a very aggressive number could, in theory, get investors thinking, actually, is the Fed going to react by increasing the speed at which it's raising rates? Especially if we get more than one positive number, this is not an aberration. And therefore, actually, how good is this for the stock market? So, not as obvious as you might think. The economy, as the saying goes, is not the stock market and vice versa. Number 2, oil prices. Just to show you that non-farm payrolls is one of the most important numbers, but there's other ones out there. So oil prices, we're still an oil-dependent global economy in many ways. I know there's moves to move away from oil dependency, but it's still vital to our day-to-day lives as consumers, companies, businesses, and so on. So investors do watch the price of Brent crude, as it's called, or alternatives like West Texas Intermediate, but they watch the price, whichever price is their personal favourite. Because it's an important commodity, you might think, if it goes up, so will the stock market. If it goes down, so will the stock market. You might think that because you think, well, if there's demand for oil, then things are going well, business is expanding, so surely that's positive. Not so straightforward as you might think, okay? Because people look at rises in the oil price and think, well, does this put pressure on consumers trying to buy fuel, for example? Is it inflationary? In other words, they look at a basket of factors when it comes to weighing up the impact of the oil price. So understanding the oil price sector and where it comes from is hard enough. Predicting its effect on the stock market is like a double whammy of difficulty. All right, so the oil price rises strongly, just to finish that off. Sign of underlying strength could be extra demand or a squeeze on supply. So that's where you need to understand the market. It could be that actually output is being squeezed. Stocks can go up or down. It depends what's driving the move, and it depends what you think of that move in terms of which way stock markets are going to go. Wage data is another one, that's important. So why is wage data important? Well, it gives an insight into the labour market. If you like, increased wages suggests that there's demand for labour. If there's demand for labour, where's it coming from? Companies doing well, potentially expanding hiring to get things going. So for consumers, rising wages definitely positive on the basis that as long as their wages are beating inflation, they might feel more confident, might spend more money, might think about buying a property, whatever it happens to be. But predicting the stock market effect is not easy. You might think, well, great, my wages have risen, I'm wealthier each month than I was before, but the stock market effect is more complicated. What I mean by that, let's say we get stronger than expected wages data. Now, it could be weaker than expected, but let's say stronger, just to give an example. That's good news for consumers, we just said that, but what about firms? Is that good news? I mean, it suggests maybe they're having to pay more, so maybe that means there is more demand for labour, but that's going to hit their bottom line. Higher wage costs, especially sustained higher wage costs, that's not quite so good for firms. So, getting the stock market impact of that piece of news, isolated from other pieces of news, pretty difficult. The economy is not the stock market, as they say. Now, if you're thinking, what about stock specific? That's three big macro examples. Let's finish with a stock. So a good example, well, I say good example, it's a slightly depressing example actually. GM recently, end of November 2018, released an announcement about cost cuts. All right, now GM used to be a star of the US stock market, really, really struggling. Technological disruption and so on has basically really moved it away from the centre of the market in many ways. So, reaction, 14,000 job cuts, massive reaction, and the closure of 7 factories worldwide. Pretty depressing for anyone directly affected or indirectly affected. But how did the share price react? Now, as an investor, there's no point in thinking it should react a certain way, because it just might not, and that's the point about markets. What actually happened was the share price rose 8% on the news the moment it was announced and finished up 5% on the day, so dipped off a bit but still positive. That was almost the highest point since the summer, around July time. Investors decided, presumably, that aggressive cost-cutting program would take the company in the right direction, could boost future profitability, and therefore they priced it in as kind of positive. Now you might say, how can that news that depressing be positive? Well, that's the point about stocks and the stock market. So how do you deal with this? Basically, I've covered this before, so I'll keep it brief. Don't be a news junkie, all right? There's loads of news around, but be really careful not to get sucked in and try and start second-guessing the impact. Don't try and call short-term market movements. I've said it before, it's hard enough to work out what the economic data is going to do, let alone the impact on the stock market. It's a double whammy of difficulty. So stick to your long-term strategy, keep trading costs down where you can, and also minimise the stress of getting this stuff wrong, and then, if you've sold, deciding when to get back into the market and so on. A lot of effort, but potentially not much reward. We have to deal with financial markets as they are, is my final point, not how we wish them to be. If it's not my final point, let's say it's Ben Carlson's at wealthofcommonsense.com. In other words, as an investor, you need to be relatively unemotional, rational. Markets follow narratives. They follow profits and expected profits. They follow trends. All right? They don't always go the way you think they're going to go, or indeed the way you think they should go. Any questions, editor@killik.com. And if you'd like to see videos on things like non-farm payrolls, then killik.com/learn.